We talk a lot about stocks and bonds in the investment world, but what actually are they? What is the difference between them? We look forward to exploring these fundamental investment options in today's Coffee and Cash discussion. Hi, I'm Ben, here from Simmons Capital Group. Today, let's talk about stocks first. A stock represents ownership of a company. If you purchase a share of stock in a publicly traded company, you're purchasing a tiny ownership portion of that actual company. The ownership comes with a number of different benefits. As a partial owner of the company, you have the potential opportunity to make money as the company makes money. This can happen in one of two ways. The company can distribute a portion of the company profits to their stockholders in the form of a dividend. For example, if a company has 100 outstanding shares of stock and they issue $100 of dividends, each stockholder will receive $1 for each share that they own. Another way for the owner of the stock to earn money is through increasing value of the stock itself, called capital appreciation. So, let's say you purchase a share of Company A's stock 5 years ago for $50. Today, that same stock is worth $172. That's a lot of growth. If you choose to sell your share of Company A stock when it was worth $172, you'll earn about $122 from the increased value of this stock between the time you purchased it and sold those shares. In summary, a stock represents ownership of a company, and you can make money owning a stock by receiving dividends or realizing increases in the stock value by selling the stock for more than you originally had bought it for. Now, let's talk about bonds. Think about bonds as loans. The owner of a bond is essentially lending money to a company called a corporate bond, or a government entity, think federal treasury bonds or local municipal bonds. In this case, the owner of a bond does not own any portion of the company or government entity itself. Rather, they have lent the entity money, and the entity pays the owner interest on that loan over time. Most bonds are issued with a par value, or repayment price of $1,000. At the end of the bond's term, the lender receives the par value, $1,000, plus the final interest payment on the bond. For example, let's say you buy a 10-year bond from Company A with a 5% coupon rate. You initially give Company A $1,000, and they agree to pay you $50 per year for 10 years until you reach the bond's maturity date. Since bonds often pay interest twice a year, you should expect to receive two $25 interest payments per year until the bond matures. After all 10 years have passed, you receive your original $1,000 loan back, along with the final interest payment of $25. In summary, bonds are loans made to the issuer. They pay interest for a period of time before paying back the full amount at maturity. Since stocks and bonds ultimately make up most people's investment portfolios, whether directly or indirectly, we hope these quick, clear summaries help you better understand the foundations of your investment accounts. Remember, as always, if you have any questions about this or other financial topics impacting your life at the present, don't hesitate to reach out to us. Goodbye for now.